Hi, this is Greg. Welcome to the channel. And if you're new to the channel, we talk here about business and investment. And the one that came up on my radar recently is a classic blue chip stock. It was recently delisted from the Dow, which was rather shocking because it is very out of favor and it has been declining for most of this year. This stock, of course, is Exxon Mobil Corporation. And in this video, I'm going to take you through the reasons why I believe that this is a once-in-a-decade investment opportunity, and I want to tell you about it, and that's what we're going to do right now. Okay, so it's not a secret that oil and energy stocks in general are extremely out of favor with the investment community. There has been a tremendous drop and volatility this year in oil prices. This has led to a sell-off in the entire energy sector, and Exxon is no exception. Now, the analysis on if this is a good investment opportunity at this point in time is a little more complicated than just looking at oil prices and where oil prices either have gone or where you believe they are going. This company, Exxon, is what is called an integrated oil company, which means that it has businesses that run the entire spectrum of energy production. Okay, exploration, refining, chemicals, etc., etc. I'm not going to spend a lot of time in this video analyzing their business. I'm just going to look at some of the basics that I look at when I look at if a company like this is cheap. And in this case, one of the most important questions that we're going to answer on this video is the dividend safe? And that dividend right now is quite remarkable. It's about 10.4% in the quarterly dividend that you will be receiving annually. So the question of, is the dividend safe, is in my mind the most important question. Now, coming up in a second, I am going to have a clip of Darren Woods. He was interviewed recently. Well, it's not that recent. Actually, it's about 7 months ago, but every point he makes is still valid today. He was interviewed by CNBC, and it is very interesting. Listen to what he says, and then I'll comment on that, and I'll have another short clip for you in a moment. Take it away.
For us as a company, and as we've talked about before, we've got to take a very long-term view. Yeah. And the investment cycles that we make are anywhere from 5 to 10 years. And so our strategy in laying out our plans is to make investments that are robust to these down cycles, and so that you can ride through them. We've got a key competitive advantage with the balance sheet, and so we build these advantage investments. They're robust to the down cycles, and then we use our balance sheet to kind of ride through these turbulent times and make sure we can deliver on those projects that then form a platform for our business to grow earnings and cash flow for the long term.
That makes sense, but maybe the oil market's even more important for you. When you're watching oil today, like we are, at oil at $47 a barrel, does any of that make you nervous in terms of what it means, even though you're looking at longer term? You got to be looking at some of these things and thinking, wow.
Well, you know, if you put it in perspective, in fact, I did that today with the investors, it's easy to get caught up in the short term, in the moment of the markets, but when you step back and look at a lot of these commodity markets, you've seen these price swings before. So we've been in this territory before, and that's why when we're making the investments, we make sure they're robust to those down cycles. So the investments that we're making in Guyana and the Permian are all robust, even below $40 a barrel.
Below $40?
Below 40. So the intent there is to make sure that you're robust to it, so that when you find yourself in those circumstances, you don't regret any of those investments.
When you stress test it, you said that makes sense for a lot of these investments below $40 a barrel. How low do you go when you're running these scenarios?
Well, we look to see, we don't have a cutoff. What we look to see is if you look at the fundamentals of those projects and then test them under different price environments, how do they respond and what do the returns look like? And if we get to a broad enough range, if you go back in time and look in history, Oil tends to move over time between $50 and $70 a barrel,
Right.
kind of a reasonable range. It'll drop down for periods, but it doesn't last very long down there. But
What if it did? What if this time's different? And I say that simply because of what we're seeing with coronavirus and what that could mean from an economic impact around the globe, starting with China.
So I think what you'd see happen is a lot of industry would pull back.
Yeah.
And particularly if you don't have advantaged projects that are going to generate returns in those lower priced environments. The economy, I think, over the medium to long term is going to continue to grow. So the demand for energy, which is closely linked to economic growth, is going to continue to grow. And so I think what you'd see eventually is that capacity that's online, as it declines with natural attrition, you're going to get a supply and demand gap between what's available and what the world needs from an energy standpoint, and then prices will come back up again.
I mean, that makes sense again from the projects and the profitability perspective of that, but there have been some numbers run just in terms of paying the dividend. You guys have a very high yield, 5.7%.
Right.
JP Morgan ran something that said they think oil prices would need to be at around $81 a barrel for you to be able to pay out the whole dividend versus I think $63 is what they put for the rest of the U.S. group. How do you look at just in terms of shorter term paying the dividend over that period of time?
So I think, we have a balance sheet that allows us to do that. So we have a capital allocation priorities, making sure that we invest for the long term so that we have the sustainable growth platform, making sure that we pay a reliable and growing dividend, making sure that we maintain a balance sheet that allows us to ride through those cycles, and then if we've got things, extra cash going into buybacks. And so that balance sheet that we've historically had is built for times like this to ride through it. Frankly, the way we look at it is we're generating enough money to pay our dividends. What we're using a balance sheet for is to make these strategic investments that are advantaged versus the rest of industry and will be required as economies continue to grow and demand picks up.
But to pay the dividend, if oil prices stay low, let's say the economy suffers for a while longer, would you cut back on some of those projects that you've been investing in? Would you buy back fewer shares? How would you do that?
So what we talked to the analysts today about is we've got flexibility. We've got a really robust portfolio of investments, and they have different time cycles associated with them. So some of them we can pull back and defer some of that spending without losing the advantage of the project and without diminishing its value. And so we've already started to do that.
Okay.
Now, to me, that clip was very interesting, and the important takeaway from it, I believe, is that number one, Exxon Mobil has enormous firepower on its balance sheet. Number two, they plan in long-term cycles. Their business planning and their capital expenditure budget is, over the long term. It takes a long-term view, and it also anticipates and plans for rises and falls of the commodity price, namely oil. The other takeaway I got from watching the interview is that I believe Exxon Mobil will do everything within its power, which is extremely considerable considering its fortress balance sheet, to defend and continue to not only pay but grow the dividend. For further evidence of this, take a look at Paul Sankey. He is one of the top energy analysts in the space. Take a look at what he has to say. Very interesting.
Longtime oil analyst Paul Sankey of Sankey Research joins us now on the Fast Line. Paul, great to speak with you. Welcome back. Oh, there you are. There you are. The picture of Paul. Good to see you. So when you heard that Exxon was being booted, what was your reaction? You've been an energy analyst for how long? I'm sure Exxon has been in your coverage for almost that whole time.
Well, look, your whole debate about decades of under and outperformance is spot on. When I started in 1990, you couldn't give away an oil stock. The 2000s, as you know, was a huge for oils, and we've had an absolute disaster in the past decade. And I firmly believe that the next decade is going to be great for these stocks. The thrown out of the Dow is sort of irrelevant in its own way, but of course it is, as you say, an ignominious moment in history and a humbling one. But Exxon's yield is now not. You haven't mentioned. You guys are all spot on, but you haven't mentioned this nearly 9% yield. And really a model that we're now looking at as a tobacco stock type option, where ultimately as the companies really focus on dividend and increasing free cash flow and really don't try and grow, this is going to be a very different investment case over the coming decade. And furthermore, now that we're not chasing growth, you're going to see oil prices, I think, rally back very, very strongly over the next 5 years.
Hey, Paul, it's Tim. Thanks for joining us. So you're talking about the dividend first. I mean, is it safe? Is it absolutely ironclad? And then relative value of the super majors, of the big integrateds. Why is Exxon performing so much more poorly than Chevron or Conoco?
Well, to start with that one, they've made some bad strategic mistakes, in my opinion, over the past 10 years. We'll go back to the XTO deal, the entrance to Iraq, and more recently, the pursuit of growth in the Permian, I thought was a huge mistake. But the yield now has been absolutely reaffirmed by the management on the Q2, the most recent call. They absolutely stated they're going to keep paying the dividend. And if you think about the financial firepower of Exxon, I think they absolutely will pay this. By the way, Chevron just borrowed money at its lowest ever coupon. So don't underestimate the financial firepower of these companies to pay you. Of course, you've seen a dramatic change of strategy, a huge change of strategy from BP, going after the environmentally friendly theme, but ultimately having to cut their dividend in half to do that. More importantly, BP said they would cut their volumes by 40%, which again underlines that you're going to get a tightening supply side here as demand post-COVID recovers. And by the way, COVID showed you how dependent we are on oil. That's absolutely incontrovertible. I mean, the fact is, what you've seen is how the world economy still runs on oil. And the whole environmental theme is really a problem for utilities. The transport side of oil is still very strong and will remain so. There really is almost no penetration of electric vehicles, and it's impossible to penetrate into jet fuel and ships. So ultimately, I think this is a cyclical low for these names as well as a secular low. I see the cyclical and the secular both shifting positively here.
Okay, so that was interesting. Well, I basically agree with what Paul was saying in that clip. And he makes a good case that the stock is clearly undervalued. Okay, so let's take a quick look at the balance sheet, and I'll show you how I'm looking at the balance sheet and the debt-to-equity ratio. Okay, so here you see Exxon's balance sheet, and I got this from the recent 10K that is a quarterly, released quarterly. And you can see, if we go down here to long-term debt, you can see as of this date, it was $46.5 billion. Okay. You can see down here, Exxon's share of common equity, $180 billion. I am going to not use that number. I'm going to take the current market cap and compare it to their long-term debt. And we'll do that right now. Okay, so here you see some stock information. You can see that there's 4.2 billion shares outstanding up here. And you can see that the share price as of the close today was 33.87. We divide those two numbers together and we get about 32%. So in other words, Exxon's debt to market cap ratio is about 32%. So what I would do is I would just assume that there's some short-term debt on their balance sheet also. So let's call it 40%. So clearly for a company of this size, they are clearly under-leveraged and they have an extreme amount of borrowing power left on their balance sheet in case they need to borrow the money to maintain the dividend. Last thing I wanted to do is show you this chart. This is the recent chart of Exxon's stock. You can see it has declined steadily over the last few months related to the oil drop and obviously related to the economic downturn. You can see that it closed recently at around $35 a share, although it was down as low as $32 a share. Now, when I did this research and I looked into it and I thought about it and dug into my past history with stocks of this nature, it really reminds me of Philip Morris back in the late 90s, early 2000s. I invested in Philip Morris before it got split up, and I owned it for a period of 5, 6, 7 years. I forget the exact time frame. But during that time, they split it into domestic and international, and then they spun off Kraft. So I ended up with stock with 3 companies. I think I made 8 to 10 times my money over that time period. This time period with Exxon reminds me of that, and I think if you were to buy this stock now, and if you were to hold this stock in either your 401k, your IRA, or some other long-term pocket of capital that you're expecting to hold stocks long-term in, and very important, do a dividend reinvestment program or a DRIP, where all of these high dividends of 10% continually is invested in more stock. I think that you're going to be very happy that you did this. Now look, the bottom line is I'm not your financial advisor. I am just someone who is doing some research and pointing out an investment opportunity to you on YouTube. So please do your own research, but I can tell you from years of experience and from digging into it myself, I feel very confident that this is a once-in-a-decade buy, and I feel that I am going to make this investment myself. And once you do your research and make your own decision, I hope you will too, because I think that you will be very happy that you did. Thank you, and please subscribe so you can be on board for future videos.